Hello everyone, welcome to our channel. This is Dr. Muralidhar. In this video, we bring you hand-picked, frequently asked and compulsory multiple choice questions from the core subject of financial management. Are you preparing for competitive exams like UGC NET and JRF in commerce and management subjects? Or SWAYAM exams? Or APPSC Degree College Lecturers in commerce subject? Then this video is very useful for you. Here I am going to provide you detailed explanation of each answer and high yield questions that are most likely to appear for the exams which are mentioned now. And this is also useful for the state level and other state level and national level examinations. Right. Now we can move on. See, the first question, DAS deals with procuring, financing, and managing business assets to achieve the objectives of an organization. Marketing management, financial management, human resource management, or production manager. Yo, the correct answer is financial management. Right. What is the main function of financial management is it is the how to acquire the funds and how to utilize the funds. So financial management is the managerial activity which is concerned with planning and controlling of the firm's financial resources. In other words, it is concerned with acquiring or procuring or obtaining, financing, and managing assets to accomplish the overall goals of the business enterprise. Mainly, the main objective of financial management is to maximize shareholders' wealth. Then move on to another question. Money being store of value serves as dash wealth. Is it working, fixed, liquid? None of this. The correct answer is liquid. Money being store of value serves as a liquid wealth. What do you mean by liquidity? How fast we can convert into the cash? Or is it in the cash form? Liquid wealth refers to assets that can easily be converted into cash or already in the cash form. Money is the most liquid asset. Being store of value means money retains value over time and can be readily used, which directly ties into the liquidity. Another question. A dash is the highest ranking person in a company or institution, ultimately responsible for taking managerial decisions. Is it chief executive officer, chief finance officer, board of directors, or managing director? The correct answer is chief executive officer. See, in the hierarchy, top level management, middle level management, lower or operational level management is there. So, the highest position in a company is typically chief executive officer. He is responsible for overall direction and performance of the company, making major strategic decisions. Underline strategic decisions and overseeing all operations. Where when it comes to the middle level, they are taking tactical decisions, whereas in operational level they are taking operational decisions of the organization. Move on to another. When the capital requirement of a company is calculated on the basis of capitalized value of its earning, it is called which theory? Is it cost theory, price theory, earning theory, or theory of profit? It is a earning theory. When capital requirement of company is calculated based on the capitalized value of its earnings, it's referred to as a earnings theory of capitalization. This approach essentially views the company's worth as a multiple of its earning capacity. This theory speculates that the value of an enterprise is directly linked to its earning capacity. Another one, the maturity period of commercial paper usually ranges from 20 to 40 days, 60 to 90 days, 15 to 365 days, 90 to 364 days. Typically, any short-term instrument or short-term investment is not more than 1 year. Similarly, commercial paper is a short-term unsecured promissory note issued by companies to raise funds for shorter duration. In most countries, whether it is including India and the US, the maturity for commercial paper typically ranges from 90 days to 364 days, means less than 1 year. Insurance is a or an agreement, contract, rating, instrument. Insurance is a contract. Yes, it is. Specifically, it is a legal agreement between an insurer and an insured party, where the insurer promised to pay a specified amount of money to the insured if a particular event occurs. This contract is governed by principles of contract law and specific insurance regulations. So insurance is a contract. So all contracts are agreements, but all agreements are not contracts, because agreement may be legal or illegal. Agreement is enforceable by law is known as a contract. So insurance is a contract. Dashed or essential to take important decisions on the basis of financial reports generated, whether it could be the analytical skills, operational skills, marketing skills, financial skills. Yes, it is analytical skills. They are the crucial for making sound decisions based on the financial reports. These skills allow for the interpretation of the financial data, identification of trends and patterns, and the ability to draw meaningful conclusions to inform strategic planning and investment decisions. So, analytical skills are most essential and crucial and vital for taking any important decisions in the organization. Then, for newly set up business, it is necessary to estimate properly the funds required for current assets and fixed assets and fixed capital, current assets and working capital and fixed assets. Here the correct answer is working capital and fixed assets. What do you mean by working capital? The capital which is needed for day-to-day transactions or day-to-day operations, like purchasing raw material, paying salaries, that is known as the working capital. This keeps the business running smoothly in the short term. When it comes to the long term purpose, so the long term investment, like fixed assets like machinery, land and buildings, they need to purchase. So the correct answer is working capital and fixed asset is necessary to estimate properly the funds required for. Which of the following carry fixed rate of interest and are to be paid off irrespective of the firm's revenue? Debentures and shares, debentures and bonds, bonds and shares, treasury notes and shares. The correct answer is debentures and bonds. They are carrying fixed rate of interest irrespective of the revenue, profitability, or earnings of the company. The company is obligated to pay the interest regardless of its earnings. This is key feature of debt instrument like debentures and bonds, as they represent debt obligation rather than the ownership in the company. Debentures are issued by the company as an acknowledgement of debt. Bonds typically generally issued by the government organizations. Then moving on to further. Dash study flow of funds beyond national boundaries. National finance, personal finance, international finance, corporation finance. The name itself indicates the correct answer is international finance. So, international finance studies the flow of funds beyond national boundaries. It is the study of flow of funds across national boundaries. It deals with and concerned with exchange rates, foreign investments, global financial systems, and financial interactions between countries and multinational corporations. Then another one. Which of the following is not regulatory institutions in Indian financial system? Whether it could be RBI, SEBI, IRDA. So the correct answer is CIBIL. CIBIL is not a regulatory body, whereas RBI, Reserve Bank of India, regulates banking and monetary policy. When it comes to the SEBI, it regulates the securities and capital markets. When it comes to the IRDA, Insurance Regulatory and Development Authority, it regulates the insurance sector, whereas CIBIL, the Credit Information Bureau India Limited, it is a credit information company. It is not a regulatory body. What it will do, it provides credit score but does not regulate any part of the financial system. So CIBIL is not a regulatory institution. Another question. Short-term funds include trade credit, factoring, commercial paper, all the above. Yes, all of the above. Then what about trade credit, factoring and commercial papers? Trade credit basically a short-term financing arrangement where suppliers allow buyers to pay later. So they are giving their arrangements, suppliers allow the buyers to pay later after some time. Then factoring, it is the selling accounts receivables, means debtors, to a third party at discount for immediate cash. When the problem is with the debtors, if they are not getting immediate payment, they are going to sell the accounts receivable to third party to get immediate cash, but at with discount rate. Then commercial paper, unsecured short-term debt instruments issued by the companies. All of these widely used for meeting working capital requirement for the company. So short-term funds includes all of the above. The next question. The conversion of dematerialized holdings back into certificates is called rematerialization, dematerialization, depository services, or mutual funds. This answer is rematerialization. Before I go further, what do you mean by dematerialization? It is the process of converting physical certificates into the electronic form. Whereas rematerialization is the reverse process where electronic holdings in demat account are converted back into the physical shared certificate. So the conversion of dematerialized holdings back into certificates is called rematerialization. Dividend tax is payable as percentage such as plus education. Basically, now there is no dividend distribution tax. The question is asked in the previous year, past year, before 20 to 2020. So earlier, the under the dividend distribution tax regime prior to 2020 April 1, companies were required to pay dividend tax at 15% base rate, which along with the surcharge and cess. So came to around 20.56%. However, the question seems to refer an older specific context where 12.5% was the base rate of tax before adding surcharge and education cess. Currently, from the financial year 2021 onwards, dividends are taxed in the hands of shareholder as per their applicable income tax slab 10, 20, 30, whatever. The DDT, dividend distribution tax, has been abolished now. So based on the given choices, on the contest, 12.5% is the correct answer for this question. Going further, Gordon suggested the higher the earnings retention rate, the greater the required future return from investments to compensate for financial either policy, company, profit, or risk. Yes, risk. What Gordon suggested basically in the dividend theories, Walter's model, Gordon's model, and Modigliani and Miller model, all these are the great models for dividend policies and theories. Where when it comes to the Gordon model, links dividend policy, earnings retention, and the required rate of return. If a company retains more earnings, pay less dividends to out shareholders, investors face more uncertainty and must rely more on the future capital gains, which increase the financial risk. Hence, the higher expected return required to compensate for that added risk. So that is the correct answer is risk. Then Dash responsible for financial reports, direct investment activities, and develop strategies, plans for the long-term financial goals of their organization, whether it is a marketing management, financial management, human resource management, or production manager. So the question itself indicates it is a financial activities, financial decisions, investment decisions, and financial goals, financial decisions. So all these are the components in the financial management. So financial management is responsible for preparing financial reports, directing investment activities, and developing strategies and plans to meet long term financial goals of an organization. Then, Equity shareholders are called owners of the company, partners of the company, executives of the company, guardians of the company. Yes, equity shareholders are owners of the company because they have the voting rights, they can climb on residual profits, and they can take the major decisions through voting rights in the annual general body meetings. Hence, they are rightly called the owners of the company. Next question. Dashed elimination of risk associated with physical scripts such as theft, forgery, mutilation, loss of share certificates, etc. Yes, is it depository system, depository participants, bank or safe deposit lockers? The depository system eliminates risk associated with the physical share certificates such as theft, forgery, mutilation, loss by converting physical securities into the electronic form, that is a dematerialization, ensures safer and faster transactions in the depository system. Then, net present value technique uses, yes, discounting, compounding, average, minimum. Yes, it is a correct answer is discounting. It is not in a compounding, not average, not minimum. So it is a financial technique used to evaluate the profitability of an investment or project. It involves discounting future cash flows to the present value using discount rate. That is typically called as a cost of capital. What do you mean by cost of capital? Minimum required rate of return by from expected by the investor from his investment is known as the cost of capital. Then summing those discounted cash flows and subtracting the initial investment, you are going to get the net present value. So net present value technique uses for discounting cash flows. A certain share of dash to be distributed as a dividend. Losses, earnings, funds, cash. Yes, it is a correct answer is earnings. Not losses, not funds, and not cash to be distributed as a dividend. So, a certain share of profits or earnings is typically distributed as a dividend. Dividends are payments made by company to its shareholders as a portion of the company's profits, serving as a reward for their investments. These distributions can be in the form of cash or additional shares of stock. Then, when next question, the process of managing client sales ledger by financial service company is called, is it forfeiting or factoring, leasing, or none of this? It is a factoring. Yes, the process of managing client sales ledger by financial service company is called factoring. Basically, factoring involves a financial service company purchasing business accounts receivables, outstanding invoices at a discount, essentially providing an advance payment for the expected revenue. This allows the business to gain access to cash quickly while the finance service company handles the collection of those invoices, outstanding invoices. Then next question is growth rate is equal to return on equity into dash. Is it lower retention ratio, dividend payout ratio, higher retention ratio, or retention ratio? Yes, the correct answer is retention ratio. So this formula is also known as sustainable growth rate formula. See, this is the rate which company can grow its sales, earnings, and dividends while maintaining its current return on equity and without issuing new equity. What do you mean by retention ratio? Return ratio is equal to 1 minus dividend payout ratio. So the retention ratio is also the portion of net income that is retained in the business. Then, medium of exchange and measures of value, or is it primary functions, secondary functions, contingent functions, or subsidiary functions? Yes, the correct answer is primary functions. These are the primary functions of money because they are the most essential and fundamental roles that money plays in an economy. What do we mean by exchange? It facilitates the buying and selling of goods and services. What do we mean by measure of value? So it provides common standard for valuing goods and services. Right. Another question. The profit maximizes emphasize the, is it for the long term, short term, medium term, wider term? So the profit maximization generally emphasize short term objective of earning the highest possible profit within limited time frame. It focuses on immediate gains, cost reduction, revenue maximization, and often ignores long term sustainability or risks. In contrast with this, wealth maximization emphasizes the long term aspect, aiming to increase overall value of the business for the shareholders over a period of time. Dash prefer higher dividend on their investments. So here the answer is income investors. It is not a growth investors. They're also expecting, but they're maintaining their reinvest profits to fuel growth. Whereas preference shareholders, they are having the fixed rate of dividends. They are not. So all of the above is not. So the correct answer in this contest, as per my opinion, is income investors. Income investors seek steady and reliable income from their investments, often through high dividends. Growth investors, they always prefer for reinvestment, and they are not expecting no dividends from the company. Preference shareholders always expect fixed dividends, so stable ones as agreed upon. So the next question: earnings which is distributed among shareholders in the form of dividend is called, is it retention ratio, earnings yield ratio, payout ratio, or proprietary ratio? It is a payout ratio. The payout ratio refers to the portion of earnings distributed to the shareholders as a dividend. Retention ratio is totally opposite. It shows the portion of earnings retained in the business. Earnings yield ratio relates to the earnings per share relative to the stock price. Profit ratio measures of the proportion of the shareholders' future earnings. Then a company has internal rate of return of 15%, retention ratio 60%. What is the company growth rate? Here clearly mentions the growth rate is return on equity or IRR into retention ratio. You are going to get the 9% growth rate for this company. Then, forecasting financial requirement is the administrative function, executive function, routine function, or cash management function. The answer is executive function. Forecast financial requirements involves planning for future capital, decision making about the funding sources, and aligning finances with business strategy. All of this falls under executive level responsibilities and not routine or administrative tasks. The next question: which of the following factors determine the dividend policy? Is it legal environment, inflation, change in management, all of the above? Yes, the correct answer is all of the above. So, all these are the determining factors for the dividend policy. It is could be legal environment, means laws and regulations can restrict or guide how dividends are to be declared. When it comes to the inflation, it affects the real value of dividends and company earnings. When it comes to the change in management, new leadership may have different approach to the dividend distribution. The next question is, elements of financial management include financial planning, financial control, financial decision making, all of the above. Yes, all of the above. So the correct uh, answer is, the financial management includes all financial planning, control, and financial decision making. So, financial planning, forecasting future financial needs and developing strategies to meet them. Controlling, monitoring, and managing financial resources effectively. Financial decision making, making choices regarding investments, financing, and dividends. The next question is, if a company form of business, the wealth created is reflected in the dash of its shares. It's a dividends declared, dividend growth, market value, or asset value. It is a market value. In a company form of business, wealth creation for this shareholders is most accurately reflected in the market value of its shares. This value represents the investor's perception of the company's current and future earnings potential and overall performance as well. The growing inconvenience of dash in the complex economic societies necessitated the invention of the money. Barter finance, exchange finance. The correct answer is barter. In the olden days, the barter system where goods and services are exchanged directly without using money become increasingly inconvenient in complex economic societies. This led to the invention of money to facilitate easier and more efficient transactions in current society. Then, types of business risk include strategic risk, compliance risk, operational risk, all of the above. Yes, all of the above. Coming to the strategic risk, it is a business relates to the business decisions and directions. Compliance risk linked to the legal and regulatory obligations. Operational risk is related to the internal process, people, or systems. Then, what is the full form of NSCCL? National Securities Clearing Corporation Limited. So please read the carefully. National Securities Clearing Corporation Limited. So here people think that it is just like the small, it is a cleaning. It is not a cleaning, it is a clearing. So the first one is the correct answer. So it is the only owned subsidiary of the National Stock Exchange of India, established in August 1995. It plays crucial, vital and significant role in the Indian capital market by acting as a clearing and settlement organization. Generally, mutual funds are of dash high risk, risk free, low risk, none of these. The correct answer is low risk. Generally, mutual funds are considered low risk compared to the direct investments in the stocks or other volatile securities. This is because mutual funds have diversified across various assets, spreading the risk overall in overall companies or other industries as well. They are professionally managed and include mix of debt and equity investments instruments depending on the fund type. So, however, it is important to note that mutual funds are not risk free. The level of risk depends on the type of mutual fund. It could be equity funds or debt funds or balanced funds. Depend on that, the risk will be identified. The next question is a firm has EBIT of 50,000, market value of debt is 80,000, overall capitalization 20,000, market value firm under net operating income approach is the formula is EBIT by overall capitalization rate, that is 2,50,000. So market value of debt not needed directly for the firm's total value under net operating income approach here. Which of the following is irrelevant for optimal cap structure? It is flexibility, solvency, liquidity, and control. Yes, the answer is liquidity. While flexibility, solvency, and control are key considerations in determining an optimal capital structure, liquidity pertains more to firm's ability to meet the short-term obligations and is generally not direct factor in capital structure decisions. Insufficient funds by investors or reputational risk, political risk, funding risk, operational risk. Yes, the correct answer is funding risk. It refers to the risk that a company or investor may not have sufficient funds when needed to meet obligations or seize investment opportunities. That directly aligns the issue of insufficient funds by the investors. The next question is the forward sale of purchase of foreign currency to reduce the exchange risk exposure connected with the assets or liabilities denominated in foreign currency is called hedging, squaring, brokering, or spreading. The correct answer is hedging. Hedging is the risk investment strategy. So they can easily reduce the exchange risk exposure. So whenever the hedging is the process of entering into financial contract, it is a derivative. It like forward contracts or derivative contracts to forwards, futures, options, and swaps to offset potential losses from market fluctuations, such as that is one of the kinds is foreign exchange risk. It is a common risk management strategy in international finance. Then, which of the following assumes constant KD and KE, cost of debt and cost of equity? Is it net income approach, net operating income approach, traditional approach, MM model? So, the answer is net income approach. So, here, an increase in financial leverage means if increase in debt proportion in the capital structure, so it will lead to the decline in the weighted average cost of capital, while the value of the firm as well as market price of the ordinary shares will increase. As per net income approach, KD and KE will remain constant. The long-term capital structure means long-term debt, preferred stock, and equity shares, or current assets and current liabilities, net working capital, shareholders' equity. The correct answer is capital structure, long-term debt, preferred stock, and equity shares. So, capital structure is a mix of all long-term sources of funds used by the company. Typically, includes long-term debts like bonds, loans, preferred stock, and equity shares like common stock, but it does not include current assets or liabilities or working capital. Financial management process deals with investment, financing decisions, both A and B, none of them, both A and B. See, as I mentioned earlier, uh, the financial management is totally concerned with investment decisions, financing decisions, and dividend decisions as well. It involves planning, organizing, directing, and controlling financial activities such as procurement and utilization of the funds. Risk arises due to, is it uncertainty, flexibility, inflation, or deflation? It is a uncertainty. Risk arises primarily due to the uncertainty, inability to predict future outcomes with confidence. This could involve uncertain market conditions, returns, or economic events. The M&M approach, Moody and Miller approach, closely looks like to the DAST approach: net operating leverage, net operating equity, net operating loss, net operating income. See, the correct answer is net operating income. Means both theories are both approaches closely resembles each other. Both sides, the value of the firm is independent of its capital structure and then set assumptions like no taxes, perfect markets, etc. So both approaches share the core concept that the firm's value is primarily determined by its underlying operating income and risk, but not the capital structure. The capital structure is irrelevant in both the cases. It could be net operating income or M&M approach in capital structure theories. Then, the statutory authority which administers the exchange control in India, DGFT, Director General of Foreign Trade, no FEDI, RBI, FEMA. So, no. So, the correct answer is RBI. RBI is the statutory authority that administers exchange control in India under the provisions of Foreign Exchange Management Act 1999. Cost of borrowed capital is also known as very important question, frequently asked question. This one, is it hurdle rate, cutoff rate, minimum alternative rate, all of the above? All of the above. So the cost of borrowed capital most accurately referred as the cutoff rate, which is minimum return project must earn to cover the cost of financing. Hurdle rate is also related to that, and minimum alternative rate is also the correct option is all of the above. Test of capital structure believes the existence of optimal capital structure. Net income approach, traditional approach, M&A approach, net approach. The traditional approach is capital structure believes the existence of an optimal capital structure, whereas weighted average cost of capital minimized and the value of the firm should be maximized. The amount of capital required by the company is calculated by adding up the cost of fixed assets, the amount of its working capital, and the cost of establishments is called, is it cost theory, price theory, earning theory, or theory of is cost theory. It calculates the capital required by the company by adding up the cost of its fixed assets, working capital, and establishment costs. An optimum dividend policy should strike a balance between dash and dash in order to maximize the wealth of the shareholders. Is it current dividend, current dividend, future growth, retention ratio, dividend, growth ratio, payout ratio? So, the current dividend and the future growth. So, optimum dividend policy aims to strike a balance between current dividends, which you have to satisfy the shareholders now, and future growth for retaining earnings to invest in the profitable projects, thereby maximizing the shareholders' wealth. The next question is, if the company raises capital by way of, the risk on the part of the company is minimum. Yes, the risk of the part of the company should be minimum. The correct answer is equity capital. Preferred stock, you have to pay preferred dividend, debenture you have to pay the interest, and long-term loan you have to pay the interest. When the company raises capital through equity, capital does not incur any obligation to repay the funds or pay fixed interest, which minimizes the financial risk for the company when compared to the debt financing like debentures or loans. In capital structure planning, issued securities are dash easily transferable, not transferable, converted into current liabilities, converted into loans. The answer is easily transferable. In capital structure planning, issued securities like shares and debentures are typically easily transferable, which enhances their liquidity and makes them more attractive to the investors. Dash debentures are debentures which are to be repaid after certain period. It could be redeemable, irredeemable, convertible, none of these. Redeemable debentures are those which are to be repaid by company after a certain period of time, either at par, premium, or discount. Irredeemable, they are redeemed at the time of winding up of the company. Convertible, they can convert into the stock at any time. Then the term capital structure means, is it a financing mix, debt mix, asset mix, fixed capital mix? See, any capital structure, the term means mix of debt and equity that company uses to finance its operations and growth. Essentially, it is a financing mix. Dash the cost of capital actual cash outflow incurred for the use of borrowed funds. Explicit, implicit, total, none of these. Explicit cost of capital refers to the actual cash outflow, such as interest or dividend payments that a company incurs for using borrowed funds. Whereas it comes to the implicit cost, it is not going cash outflow. Suppose if the owner is using his own building for his business, he is paying rent for the building, that is not comes under the cash outflow, where total cost, both explicit and implicit cost, is known as a total cost. So here the correct answer is explicit cost. According to the constant dividend per share dividend policy, a company follows a policy of paying certain dash as a dividend. Fixed percentage of share, fixed amount per shareholder, fixed percentage per shareholder, fixed percentage per shareholder. Here, the correct answer is fixed percentage per share. Here, constant dividend policy means a company pays fixed dividend amount per share regardless of the earnings level. This effectively means fixed percentage per share, assuming the share price remains constant. Whereas regular dividend policy means the company continuously every year they are paying the dividend to the shareholders irrespective of the percentage. That is the difference between constant dividend per share and regular dividend policy. Then if EBIT is 15 lakhs, interest is 2,50,000, corporate tax is 40%, degree of financial leverage is, it is easy to calculate EBIT by EBT, so it is 1.20. Then purchase of machinery is dashation, current investment, capital or cash. In my opinion, here this is the purchase of machinery capital investment decisions. It falls under the capital expenditure, which involves investing in long-term assets that will generate revenue over period. But here appropriate answer is for out of four options capital decision, because investment decision may be long term or short term. So here the capital decision is the correct answer for this. Operating leverage may be defined as a contribution to EBIT. The correct answer is EBIT. It shows how sensitive the operating income to changes its sales. Trade credit is granted to whom? Manufacturers and traders, customers, government, supplier. Customers. This trade credit is short-term financing option typically extended by suppliers to their customers, allowing them to buy goods or services and pay later. Thus, analyze the relation between the sales level and EPS. Here, it is a not financial, not operating, but combined leverage. Combined leverage examines how changes in sales affect EPS by combining the effects of both operating and financial leverage. Computation of financial leverage, when there is a equity share capital and debt capital and no preference share capital, is the formula is EBIT by EBT. EBIT means earnings before interest and tax, shows the company's profitability before interest tax expenses. When it comes to the EBT, it is after interest has been deducted. Financial leverage measures how much a company using debt to increase potential returns to the shareholders. This is ratio shows the sensitivity of net income to changes in EBIT due to interest expenses. Relationship between changes in sales, changes in operating profit is known as operating leverage. So contribution by EBIT. Contribution means sales minus variable cost. So company with high fixed cost and low variable cost will have higher operating leverage, meaning small changes in sales can lead to the large changes in the operating profit. So the customer advances are issued to whom? Government, creditors, debtors, or customers? Yes, customers as itself. The customer advances are amounts received in advance from customers before the actual delivery of goods or services. It represents a liability for the business until the goods or services are provided. So, customer advances are issued to customers when they pay in advance for future purchases. Then methods of capital budgeting or accounting rate of return, payback period, net present value, all of the above is correct answer. Accounting rate of return is based on accounting profits. Payback period means time taken to recover the initial investment. Net present value cash inflows minus outflows considering the time value of money. Then, short-term investment include securities purchased and held for sale, securities for long period, no, securities for short period, yes, securities for moderate period, no. Securities for short period. Short-term investments, also called marketable securities, are temporary investments, refer to investments that are easily convertible into cash, intend to be held for shorter period, usually less than 1 year, and purchased with the intention of selling in the near future. So short term investments is nothing but securities which are meant for the shorter period. See, the next question is, short term investments include, the same question has been repeated here. Then goodwill is an tangible asset, intangible asset, fictitious asset, none of the above. It is an intangible asset which we can't see, which we can't touch, which we can't feel, but it is having the value. Intangible assets are non physical assets that have value. It represents things like brand reputation, customer loyalty, employee relations, and other factors that contribute to the acquired company's profitability but are not separately identifiable. Current assets are meant for short term span, like bills receivable, cash, prepaid expenses, raw material, are maintaining the short term assets that are expected to be converted into the cash within 1 year. The term on which financial institutions provide loans, such as interest rates, collateral, duration, also affect on capital budgeting. That is called lending policies, capital structure, working capital, or return on capital. The correct answer is lending policies. Define the terms and conditions on which financial institutions provide loans, including interest rates, required collateral, and loan duration. These terms significantly influence the company's capital budgeting as they affect the cost of financing projects. Asset valuation helps to identify the right price, market price, cost price, none of the above, right price. So asset valuation is the process of determining the fair or right price of an asset based on the various methods such as market value, income approach, or cost approach. It is not limited to the current market price or cost price, but rather aims to find justified fair value for decision making purposes. The next question is, material purchase written under dash in the cash budget. Is it opening balance, payments, receipts, or closing balance? It is in the payments. Normally, it's the material purchase means you have to make the payment in the cash budget. Material purchase are recorded under the cash payments or cash outflow section. The method bases the value of asset on its market price or its projected price when sold in open market is called cost method, market value method, base stock method, standard stock method. That correct answer is market value method. So this method values an asset based on its current market price or projected selling price in the open market. The other options are incorrect because cost method is totally based on the historical cost. Base stock method is depend on the certain amount of stock is always kept on hand. Standard stock method is a valuation method. It may be company specific or less common approach. The next question is, technique of payback period is used in technique of internal rate of return, budget, capital budget. None of this. No, it is a capital budgeting. As I mentioned earlier, payback period is method used to determine the amount of time required for a project to generate enough cash flows to recover the initial investments. Then coming to another question is, a discount factor multiple by cash flow over the year will give you cost of capital, net present value, internal rate of return, return on net present value. So it is the difference between present value of cash inflows and present value of cash outflows over a period of time. It is calculated by discounting future cash flows back to their present value using discount rate and subtracting the initial investment. Compared to the manufacturing sector, service sector requires, is it less working capital, more working capital, more or less same working capital, moderate working capital? It is a less working capital because service are delivered directly. It doesn't involve any inventory. It offers with quicker cash turnover. So the operating cycle is also very shorter in the service sector. Following is the example: holding cash by transaction motive is provision for strike, provision for flood, provision payment of salary, increase of interest rate. The correct answer is payment of salary. People hold cash to meet their day-to-day expense in the case of transaction motive, whereas people hold cash God against unexpected events like strikes, floods in case of precautionary motive. Then gross working capital means, see, the basically gross working capital means the total current assets, not total current liabilities. Current assets minus current liabilities is known as a net working capital. Current assets plus current liabilities is nowhere concerned here. So the cost working capital is nothing but total current assets. Cash budget is more helpful in business concerns where there are no seasonal fluctuations, wide seasonal fluctuations, rare seasonal fluctuations, and all of the above. Wide seasonal fluctuations. It helps business manage liquidity, plan for cash shortages or surpluses, and ensure smooth operation during the both peak and off-peak seasons. Then, which is not included in the current assets, debtors, bills receivable, cash in hand, and inventory. So, debtors, cash in hand, inventory are the current assets, whereas bills payable is current liability. The correct answer, bills payable. Internal rate of return is considers time value of money, historical value of money, historical as well as time value, none of them. The internal rate of return considers the time value of money is the correct answer. It is the discount rate that makes the net present value of all future cash flows from project or investment equal to zero. It explicitly considers the time value of money, which means it recognizes the rupee or dollar today is worth more than the same amount in the future. It is required to meet the seasonal needs of the enterprise. It is permanent working capital, regular, seasonal, temporary. So, seasonal working capital refers to the additional working capital a business needs during certain periods of the year when sales or production levels rise due to seasonal demand. In case of more than one project, rule of acceptance will be the first one is accept project having highest NPV, not lowest, not average, none of these. So typically the most desirable and should be accepted assuming there are no constraints like budget limits or resource shortages. Under dashed, if the present value of future cash flows is higher than the initial cash outlay, the project is selected or otherwise rejected. Net present value. So, a higher NPV means greater expected profitability after accounting for the time value of money. IRR focus on yes, it is a break-even cash flow level of project. Yes, surplus arising from the project. No, losses arising out of the project. No, surplus and losses arising out of the project. No. So, present value of cash inflows is equal to present value of cash outflows is known as the IRR. At which rate? This represents the break-even point in terms of return. So IRR focus on finding the break-even cash flow level, the point at which the project neither makes profit nor incurs loss in present value terms. Cash management is one of the more important areas of dash management. Working capital management, fixed capital, capital, no, no, working capital. The components is cash management, receivables management, and inventory management. Issue share capital is what? Cash flow from financing activities or investing or operating or cash outflow from financing activity. Cash flow from financing activity. So the issuance of share capital is classified financing equity on a cash flow statement. It involves raising funds for the business through equity or debt. Longer the process period will be dash. Lesser will be the working capital. Larger will be the working capital. Minimum will be the working capital. None of the above. Larger will be the working capital is the correct answer. A longer process period generally requires a larger working capital requirement. This is because the longer the time it takes into convert raw materials into finished goods, the longer funds are tied up in the production process, requiring more investment in inventory and work in progress. Increasing outstanding salaries result in it increase in cash outflow, increase in working capital, decrease in funds flow, decrease in cash flow. Here decrease in funds flow. So increase in outstanding salaries means salaries have been incurred but not at paid. This is current liability. If it increases current liability like outstanding salaries reduces the need for funds because payment is deferred, it will be done in the future, hence it results in a decrease in funds flow. CFS cash flow statement is made mandatory according to which standard? Yes, according to Account Standard 3 revised as per ICAI, Indian Institute of Chartered Accountants of India. So it becomes mandatory. Earlier, trading profit and loss account and balance sheet are the mandatory financial statements. When it comes to the cash flow statement, this standard prescribes the method of presenting cash flows from operating, investing, finance activity and is applicable to all companies except small and medium sized enterprises as per ICAI's classification. In a factoring non-recourse transaction, the loss resulting from bad debts is borne by an intermediate organization, finance manager of the organization settling accounts receivable, selling accounts receivable, organization by buying accounts. The correct answer, organization buying the accounts receivable assumes the risk of bad debts. This means if the debtor fails to pay, the seller of the receivable is not liable. The loss is borne by the factor himself. Profit maximization is a short-term goal which can be achieved at the expense of the firm and its stockholders, depositors, creditors, and debtors. In my opinion, the correct answer for this is creditors. It is a short-term goal, can sometimes involve actions that ignore long-term obligations such as delaying payments or taking excessive risk. These actions can negatively impact creditors who rely on the firm's financial stability and repayment ability. Accounts receivables are reported in the balance sheet at which value? Face value, gross value, net realizable value, non net realizable value. This is the amount of cash the company expects to collect from these accounts, which is the gross amount of receivable less doubtful accounts, allowance for the doubtful account, provision for doubtful debts, doubtful bad debts. This approach acknowledges that not all customers will pay their debts and provides more accurate picture of the company's financial position. Market value of the shares is decided by the respective companies, investment market, government shareholders. Investment market, neither respective companies nor the government and nor even shareholders as well. Market value of the shares are decided by the investment market, the price an asset would fetch in the marketplace. An example of derivative security is not common share, but it is a call option and commodity future contracts 2 and 3. So answer is 2 and 3. Example of derivative security is call option or mobile stock and commodity futures contract. A derivative security is a financial whose value depends on the some underlying asset, means another asset. Most investors risk averse, which means so they will assume more risk only if they are compensated higher expected return. They will always investments in the lowest possible risk. They avoid stock market due to high degree of risk. None of them. The correct answer, they avoid stock market due to the high degree of risk. Most investors are risk averse, which means they avoid stock market due to high degree of risk. A risk averse investor, on the other hand, dislikes risk and thus stay away from high risk stocks or investments and is prepared to forego higher rates of return. The cost of retained earnings is equal to the cost of equity because the correct answer is cost of equity. It's not cost of debt, cost of bank loan or cost of term loans, but it is a cost of equity. See, the cost of retained earnings is the earnings foregone by the shareholders. In other words, the opportunity cost of retained earnings may be taken as the cost of retained earnings. EBIT usually same thing as funds provided by the operations, earnings before taxes, net income, operating profit. The correct answer is operating profit. It is a company's net income before income tax expense and interest expense have been deducted. EBIT is used to analyze the performance of a company's core operations without tax expenses and the costs of capital structure influencing the profits. And treasury bills are traded in the money market, capital market, government regulated. Money market is traded in the money market. There is short-term debt instrument along with that certificate of deposits, commercial or papers are also traded in the money market. At the wholesale level, it involves large volume trades between the institutions and the traders. Thank you. Thank you, one and all. Thank you for staying with me. Stay tuned to boost your chances of scoring high marks in the competitive exams. Thank you. Thank you, one and all.